Hi, I'm Victoria with High Level Knowledge LLC. I am a mortgage professional that specializes in mortgage underwriting training. Today, I want to talk to you about one of the calculations that is very important when it comes to mortgage underwriting. As you guys know, mortgage underwriters are the individuals that actually can approve or deny a loan when you send a loan for approval to a lending institution or a bank. The mortgage underwriter is the person that actually makes a decision whether you qualify for the loan or not, and this is based on documentation that is provided to the bank and of course the information they require. However, throughout the process of underwriting a file, there's some calculations that have to be done by the mortgage underwriter. And there's one calculation in particular that actually can determine whether a file qualifies, is approved or denied. So this calculation is called a DTI, which stands for debt to income ratio. And what that really is basically a percentage of your debts divided by your gross monthly income. So your gross monthly liabilities divided by your gross monthly income. So I have prepared a small presentation for you, which shows you all the breakdowns of how this is calculated and what's actually taken into consideration when it comes to calculating this DTI. So please like and subscribe to my channel if you like this video, and I will continue to provide you more information regarding mortgage underwriting. Also, if you're interested in pursuing a career in the mortgage industry, High Level Knowledge LLC provides mortgage underwriting training. You could go to the website highlevelknowledge.com. We have courses that specialize on mortgage underwriting training, as well as reviews or documentation for mortgage underwriters. So if you're interested in becoming a mortgage underwriter, a processor, or just someone that's interested in going to the mortgage industry, I highly suggest you check out some of the courses that are available there. Thank you, and stay tuned for the presentation. Bye.
How to calculate a DTI. So first, what is DTI? So DTI stands for debt to income ratio. And when it comes to mortgage underwriting, this is actually a determining factor whether someone qualifies for a mortgage loan or someone is declined for a mortgage loan. So basically, it's your monthly liabilities divided by your gross monthly income equals to a DTI. However, when it comes to mortgage underwriting, there are certain liabilities that have to be included and there's others that are actually excluded. So I have an example for you just to show you what they are. So for example, an example that I have here, these are the types of liabilities that have to be included when it comes to mortgage underwriting. So you have items like your mortgage payment or rent, a car lease or auto loan, a credit card, student loans, installment loans or loans, personal loans, child support. Those are the types of liabilities that actually are included in a monthly for the monthly calculation of a DTI. To give you an example of the type of liabilities that for the most part are excluded from this calculation are items like your cell phone bill, your water bill, electricity bill, or cable bill. Those are items that usually are not included for the most part on DTI calculation. Now, this is then divided by your gross qualifying monthly income. And again, your monthly income is determined whether you are a wage earner or you're self-employed. So as long as you meet the requirements and documentation or what the bank that you're applying for or lender is asking, they will calculate what your gross qualifying monthly income is. So on the example that I have here, we have a total of 2,866 in liabilities and 9,500 in qualifying income. So if you actually take the liabilities and divide it by the income, you're actually going to get 0.3016. And then you just turn that number to a percentage, and that is how the DTI is calculated. So again, it's all your monthly liabilities divided by your gross qualifying monthly income. It's a manual calculation. Of course, a lot of banks will have softwares that will do this calculation for you. But if you ever want to know what your DTI is, this is how it's calculated. Again, it's very simple. You will take your liabilities divided by your gross income. That percentage is your DTI. Thank you. And if you're interested in more mortgage training, please visit highlevelknowledge.com. Thank you. Bye bye.